Hello and welcome. I want to take a minute to go over this amazing console that we will be using so that you get the best experience during the webcast. This console is fully customizable. You can reshape, resize, and move all of the windows. The widgets for today's webcast are the presenter slides and media player, where you will view the webcast presentation. We have the Q&A to ask questions that the presenters will be answering throughout the webcast. The speaker bio will give you information on the speakers and links to contact them. And in the resources, you will find all of your goodies like your slides, your handouts, and your giveaways. The group chat is where you will chat back and forth with the other attendees. And if you want to tell somebody about this great webcast, but you don't want to leave and miss a thing, that is not a problem, because we have a suite of social media icons to choose from, so you can tweet and post about this webcast. You can even invite a friend with the Refer a Colleague widget, and you never have to leave the platform. The Help widget will open a new window to help you with technical difficulties that you may experience, and the survey will be used at the end of the webcast to let us know how we did, what we can do better, and topics that you would like to see in the future. To clean up your console for better viewing, simply click on the widget for the window that you would like to close. As a few last details, please remember to sign out of or disable all of your pop-up blockers. This is an audio broadcast, so to get the best sound quality, all of the sounds for this webcast should be coming directly through your computer. We are recording and you will be receiving a copy, but you will want to stick around for the live Q&A and special offers at the end. We are excited to have you here today. Please sit back, relax, and enjoy this opportunity to mastermind with your Originator Connect network.
Well, hello and welcome everybody to the next installment of the Originator Connect Network webcast series. Today's program, we've got a special informational program for you, focusing on what you're going to do when the market dries up and how to prepare for the changing and coming markets and develop a business source and stream that will be stable and there for you, even in the worst of markets. If real estate values go out of control and interest rates go psycho, you'd still have a foundation to work a solid and sustainable business. So I want to make sure that you guys are aware, by the way, that this is a very interactive program. It's intended to have a real conversation with you all as audience members and guests here at the Originator Connect Network. We want to hear from you. We want to know what you want to know more about in the details of the comments. There's two main widgets that we're going to use for that purpose. The first one is really the Q&A. That's where you're going to want to ask those technical questions that you want to dig deeper on as we go through the process of the webcast today. The group chat is also a great feature that you can use to communicate with your peers around the country and share thoughts, insights, success stories that you would like to know from the rest of the audience, what you would like to hear more about. Secondly, we also have the options where you can share this with others. Like if you see something that's really profound that you know you've got a real estate investor group that you work with already or a group of realtors that you want to encourage to join or watch this program in an on-demand environment, you can always use the Refer a Colleague widget to send them an introduction or an invitation live in real time as you're going through this program without having to miss a second of the program. So without further ado, let me get into the introduction program and our guest speakers today who are going to be sharing a ton of really valuable information with you guys as we go through this program. Our special guest and our sponsor for today's event is CoreVest Lending, one of the top leaders in the field of investment property and renovation lending. One of our guest speakers is Mr. Ryan McBride, who is the Chief Operating Officer for CoreVest America Finance. Been with them since August of 2014, that particular role. He's also had a long and very illustrious career with a variety of different companies over the years, a real expert in the field of this type of lending. Secondly, we have Mr. Sam Bajelic, who is the Vice President of Wholesale Lending for CoreVest. someone I've gotten to know very well over the last couple of years, all the conferences we've been to together, and many beers we've shared together, having some great times and some great opportunities to network and get to know each other. Someone who's become a true friend, somebody I feel is a true expert in the field and has a ton of great information to share with all of you today. So let me step out of the way and let Sam take over so that you guys can get all the value that you possibly can in the next 58 minutes. Sam, take it away, bud.
Hey, well, thanks very much, Eric, and welcome, Originator Connect Network. This is a second in a series that we've partnered with you on here at CoreVest Finance. I think the last one we did was in the summer. It was, I think, July. We really appreciate the opportunity to come back. What we're going to talk about a little bit today, I'm going to kind of set the table of what the next hour is going to be. First part, we're going to talk a little bit about CoreVest Finance. I feel it's always important to know who you're talking about, who's the people, that are going to be presenting today. So that's important. We'll talk about the opportunity, why investment property loans, why rental properties, what's the opportunity there for you as an originator to expand your business, to grow your business, to build repeat clients. Next, we'll talk about the marketplace and what products, what buckets are out there to fill up with these types of loans. Then also we'll look at how to partner with us here at CoreVest, and we'll look at some action items. What are some next steps that we can partner on together to bring more loans to the table for you, to build your client base, to build repeat business for you and your employees. Also, I wanted to point out, stay tuned towards the end of the conversation. We're going to have a promo for all the Originator Connect attendees. Short promo will run in November for those of you attending, so you'll get some information on that at the end of the presentation. So with that, what I'd like to do is hand it over to Ryan McBride, our Chief Operating Officer here at CoreVest Finance. He's going to talk a little bit about the marketplace, the firm, and the opportunity. Thank you.
Thank you, Sammy. Thank you, Eric, for hosting us today and also saying all the nice words about me up front. Doesn't usually happen, but thank you. Well, just a few slides here in a few minutes about CoreVest. We're excited to be here again today. One thing to know about CoreVest, we're a private lender. We're very well capitalized, and we're focused exclusively on residential real estate investors. We're a leader in the space. We've closed about $4 billion over the last 4+ years. And we've really built out a platform to serve our investor clients as well as those partners that we work with, whether it's brokers, wholesalers, or correspondent partners. A little bit about our history and our mission. We do come from a pretty unique standpoint in the sense that prior to starting CoreVest, we were actually investors. I was one of the original founders of Colony American Homes, ran acquisitions, purchased really the first 30,000 homes on that platform for rental properties. And as part of that effort, myself and some of my other colleagues, we realized that the SFR market was quite large, even bigger than we thought. And one of the things that stood out was the small and mid-sized investor didn't have access to scalable debt capital. So we really started CoreVest, or at least our predecessor at that point, to serve that market. And we've seen a lot of success stories and been really fortunate to help a lot of our partners grow. A couple of examples where we have groups that maybe started off with a handful of homes and now they have dozens of homes. And we've had groups that have had dozens of homes and now have hundreds, if not thousands of homes. So all of that has been made possible by providing people with scalable debt capital as part of our solutions. Just a quick snapshot of where we operate. We're in 46 states, as you can see from the map. We do have significant offices in California as well as in New York. We do have boots on the ground in certain other states where we have densities of potential customers. But safe to say, we do offer our loans just about nationwide. And you can see from where we're operational, we've financed 29,000 properties in these states. And we'd like to continue to expand our footprint. Just one quick slide while I leave you and turn it over to Sammy again here in a second. We do think we're the leading lender for residential investment properties. We've closed $3.7 billion plus and counting since our existence, 29,000 properties across the U.S. We do have multiple delivery channels. We work with brokers, we work with correspondents, we work with wholesalers. We also do direct for the larger loans that we originate. And I think one of the things that's particularly interesting is we have multiple products that we can offer out and really cover any residential investment scenario, whether it's an individual fix and flip type of loan situation, all the way up to individual rental properties or portfolio rental properties that might need a 5, 10, or 30-year term loan on those. So with that, I'm now going to transition it over to Sammy, who's going to walk through some pretty interesting survey questions here as we go forward.
Well, thanks, Ryan. While we have you here, the audience, I just want to ask you a couple questions. Want to kind of stimulate your brain a little bit and think, think differently. I know you've spent the last, probably post-crisis years working mainly on the GSE products, the Fannie, Freddie, Ginnie Mae products, and not until the last couple of years have you seen alternative financing companies come into play. Some of the non-QM companies, some of the commercial companies, some of the hybrids like us here at CoreVest. So, real quick, just a question. I want you guys to go ahead and click on a yes or no here. Do you have clients that purchase multiple investment properties per year? What we find, just a little side note, what we find with these clients, these are ones that come back every quarter, every month, sometimes multiple times per month. So just want to know if you run into any of those, throughout your origination cycle. All right. I think we have the next one. Oh, look at that. All right. So we've got roughly a little over 60% there, purchasing multiple properties per year. That's great. Hey, next quick question I just want to pose to you. Have you ever turned down loans on these rental properties because maybe the sponsor or the investor's tax returns will not support the typical Fannie or Freddie DTI guidelines? We know Full Doc's tough, right? These professional investors, their tax returns are complicated. The 1040s, the K1s, the Schedule C's, the Schedule E's, they've got a complicated tax return, and sometimes the rents don't line up, or maybe some of the other businesses they own don't line up. And have you ever had maybe an instance in the last year or two where you had to turn down a loan through Fannie or Freddie, through DU or LP because of the DTI restrictions? So just trying to get a feeling for the type of loans that you're seeing. Thank you there. So, hey, look at that. So we've already kind of established, we see about 65% of you see multiple investment properties. We see a lot of you turning these down sometimes because of DTI. So just appreciate you sharing that with me. Hey, last quick question, then we'll get back into the presentation. So what about foreign nationals, right? We've worked a lot with U.S. citizens, all of us, buying owner-occupied homes, second homes. Have you ever come across a foreign national that maybe wanted to purchase an investment property? We saw a large amount of these foreign nationals come in during the crisis, post-crisis years, 09, 10, 11, 12, buying with cash. And now some of these foreign nationals looking for leverage. So just curious if you've had a foreign national approach you, perhaps you couldn't get it done, through traditional financing, and just want to get a little color on what you're seeing out there in the marketplace. So if you've seen a foreign national, please click yes. If not, please click no. All right. So that's good. We're seeing a lot of you are seeing these types of loans. That's great. Again, we're seeing a lot of multiple investment property clients coming to you. We see some that are tough. Over 80% were tough getting done through traditional financing through Fannie and Freddie. And just by this quick survey here, we see over 70% have also found a niche in foreign national lending. So thanks for your time on these questions. And right now, what I'm going to do is hand it back to Ryan. He's going to talk a little bit more about the actual rental loans themselves and why investment property loans. So, Ryan, back to you, sir.
Sammy, thank you. As Sammy mentioned, I'm going to give a little bit of a backgrounder on the types of loans that we offer, as well as the overall market dynamics, just to give you a better sense for the investment loan market, and in particular the rental market, because I think it's important that everybody's operating off the same baseline set of information. First off, what are residential investment loans? It's pretty straightforward. The best way to think of it is a business purpose loan on a non-owner occupied property. And this can be for a single family residential asset. It could be for a townhome. It could be for a condo, and even small multifamily. We finance those as well. One of the things to keep in mind is that the residential investment market, in particular SFR rentals, has been around for a long, long time. It's only really over the last few years where there's been a lot of attention paid to this sector, and that's largely through a lot of larger institutions coming in during the wake of the financial crisis that created a lot of media sensation around that. Again, one of the things that's most interesting about this market is it's comprised of small and medium-sized investors, which is why we formed the company and where hopefully you'll see your clients emerge as very good candidates for loans in this space. This next slide talks a little bit about the underlying composition of the SFR rental market in terms of the number of assets that are out there, because I think it's important to understand how big the collateral is underlying this space. So if we focus on kind of the upper portion of this slide, this green or tier color little monopoly houses here, that's really where we're going to be focusing in on what the numbers are. You see that there's about 46 million rental units. Out of that, about 30 million rental units are applicable to our programs. That translates into about $3 trillion of property value that's available for us to finance. So what does that mean? Very large underpinning market means a very large potential loan market that's out there for all of us to capture going forward. A lot of information on the slides. I think my analysts were trying to win an award, but I'll cover them pretty quickly here. I think at the top left, you see the home ownership rate decreasing, the rental ship rate increasing over the last several years, really in the wake of the financial crisis. What's important about this is for every percent step up in ownership rate, that's about 1.2 million in terms of new renters. So we've added well over 6 million renters to the equation, over the last, 5 to 10 years in the wake of the financial crisis. And I think what's important is we don't really see that changing much. So the rental market has really expanded through a lot of different reasons, whether it's demographics or dislocation, or really even changing tastes as the millennial generation takes hold. We look at a group that likes to rent a lot of things. They rent scooters, they rent movies, they rent music. They also rent clothes, and so why not rent houses? So we're seeing more and more uptake on millennials really looking towards renting homes as well as other people. One of the fascinating things shown on the bottom right-hand side is that the rental market has always been strong. Most people associate that with multifamily, but as you can see from this chart, historically speaking, single-family rentals has always been one of the biggest, if not the biggest component of rental housing for a long, long time. So if you look at the far right bar chart, 35% of all rental units are single-family residential properties, which are, again, very appropriate for the loan products that we produce here. This slide, I think, is interesting because what it shows is nationally how popular rental properties are in each state. 36 states have rentals comprising more than a third of the housing stock. So I think this is an interesting one for you to take a look at in the areas that you operate to see how prevalent rentals might be, because again, that talks about the opportunity that lies out there in front of you. One of the questions we get, which is addressed here on the next slide, is what's the impact of rising interest rates relative to our products? And we actually see the rise in rates being somewhat positive for our product, if not very positive, for one reason, is it tends to be a demand driver. And what do I mean by that is, as you can see from the chart, and I think as you all well know from your own experience, as rates increase, it makes it more expensive for the owner-occupant to actually purchase a new home. Well, those folks still need a place to live, so what that tends to do is drive more demand for the rental market. And when that happens, we see rental investors pick up the pace in their activity, and what that means is it creates more loan opportunities for all of us. So with that, I'm going to turn it over to Sammy again. He's going to walk through how investment loans in the residential investment space could be beneficial to you and your businesses.
Hey, well, thanks, Ryan, and again, thanks to everyone for joining. We know your time is valuable. We appreciate you tuning in today. So why offer these residential investment property loans? That last slide that Ryan showed kind of, for me, makes the most sense. We're in a rising rate environment, and every time 100 basis point in rates and the rate moves up, we see over 1 million folks won't be able to qualify to purchase a home. So I know there's a lot of camps out there that I see no renter left behind. I see fire your landlord a lot on LinkedIn. I think it's great. We live in a great country, right? No matter what side of the aisle you're on, this is a great place that you can own your own home. It's a great place that you can buy investment properties and have a business of owning homes. And I think going forward, what I want you to think about and take from this today is how can you grow your business? How can you get more investor clients? Because again, it's great for someone to buy an owner-occupied property and to come back 3 or 4 years later, maybe to upgrade. But I think it's even better to get someone to come back every quarter, every month, maybe 4 or 5 homes a month they want to buy, and help you build an annuity of clients, of investment property clients in your business. So again, why offer these loans? It's a huge industry, as Ryan mentioned. We're talking 16 million single family rentals, over 2 trillion in the space. And now alternative lending's here. So companies like ourselves, where we don't discriminate against professional investors that own multiple investment properties. We close in LLCs, and we'll get to a lot of that here later in the presentation. I just wanted to kind of touch on that. So the next slide will go a little bit more in detail on that. Again, who are these types of clients? Who should you be looking for? Again, professional investors, they want to close in LLCs. Very, very important. They might not qualify for Fannie or Freddie traditional financing because of the income documentation. We talked about that. The asset documentation over the last couple of years has been very difficult for these investors to qualify due to the higher requirements by the GSEs. Again, we feel it's an easier underwrite because we're not looking at tax returns. We're not looking, again, at Schedule C's, Schedule E's, different parts of the tax return. We're using the cash flow of the portfolio or of the individual rental unit to qualify. So we're looking at the lease to qualify. So also, there's a lot of hard money loans out there. Investors buy the properties, leverage using a hard money loan, and now they need to stabilize the property to get a tenant in there in long-term rental strategy. Again, these are the types of clients that you should be looking for. And I think right now what we'll do is we'll take a look at some of the clients that have leveraged our products and some of the advice they can at least give of their experience.
It is the main source of my acquisitions through bridge financing, and then I roll it into the term financing. I'm able to get my capital back once I do that, and I go do it again. So it's probably the secret to my wealth.
They pretty much saved our business because without them, we wouldn't be able to continue buying and get out of the hard money. They helped us grow exponentially, and they've been hands down the best to work with.
Well, great. So hey, let's now we're going to talk about the marketplace. Let's take a quick look, I guess, at the marketplace and the lending products that are out there. So who funds these loans? Well, we'll look at a couple different ways. Traditionally, they've been funded. Friends and family, that's a great way. If you can raise funds from relatives, great way to borrow money. Could be a low cost, might be a little sometimes dicey working with relatives, but there's definitely an opportunity there. Local banks are great in their respective markets. Again, they might not want to go outside of the branch footprint, but they've traditionally financed these professional investors. There is an online marketplace, somewhat fragmented, possibly maybe some not as I don't say genuine as others, but as far as the certainty of funds and can you get the loan closed on time, sometimes you might struggle with that. Cash is king, right? Savings, that's a great way to buy them. Unfortunately, there's not unlimited resources out there of cash, at least for me, but most investors want to look at somehow leveraging the cash that they have. And that really brings us to specialty lenders like ourselves here at CoreVest. There's a great way to utilize our products, the alternative lenders in the marketplace, again, the non-GSE lenders, to use the products, leverage the cash that you have to be able to build the portfolio, to be able to rehab the distressed properties that you might have. so you can get a tenant in there and get them stabilized. So again, this is all we do every day here at CoreVest. All we do is investment property loans. So that's our specialty here. And we'll talk about a few of the products, I think, on the next slide that we have. So there's about three different buckets of products that we classify our loans in. Going from left to right, so left to right, single rental property loan. This is a one loan, one property, 1 to 4 family. This is going to be for your stabilized rental. So this is going to be rent ready. Again, no limit to the number of properties owned by the investor. These typically close in LLCs. It's not a full doc loan. Again, we're going to use the cash flow to qualify. So we're going to use the lease of that property where the tenant has to qualify. We're going to calculate a debt service coverage ratio. If it's a purchase scenario, we will use the market rents, which are located on the 1007 of the appraisal, and we could talk about that maybe at the Q&A period or even offline. Also, this gives you a national footprint. These are not TRID loans, right? So they're not even really non-QM loans. They're commercial mortgages or they're business purpose loans on residential real estate rentals. So by working with companies like CoreVest, it gives you the leverage, gives you the opportunity to originate loans throughout 44 states throughout the United States. So keep that in mind as you're looking to grow here. Planning for Q1 of next year and all of 2019 and beyond. These types of loans will give you the opportunity to go outside of your normal state or regional footprint. So rental portfolio loans in the middle there, that product, that's going to be for the larger investor that owns typically more than 5 units. More than 500,000 is going to be the minimum on that. They're referred to sometimes as blanket loans, so perhaps that might ring a bell with you. These are 30-year loans, right? So the amortization is 360 months. They're 5, 7, and 10-year term, so the rates will be fixed for a set amount of time. They're available interest only or full P&I. Again, 75% loan to value. We do calculate that also on a debt service coverage ratio. DSCR is a terminology that you'll hear out there in the marketplace. And again, these are for stabilized rentals. On this, we do 1 to 4 family as well as some small multifamily can be also put in those portfolios. So keep that in mind. On the right-hand side, this is our bridge product. We refer to this as fix and flip. That's kind of the more common that you hear in the marketplace. These are available on individual loans. So we call those single asset bridge loans, as well as lines of credit. So the line of credit would be established for your investor to go out and purchase either bulk or individual properties kind of on a flow basis. Well, we will underwrite the actual sponsor, the client, and then qualify them for a certain amount of money. And then each individual property that they identify, we'll underwrite those properties as they come in. So again, individual rental loans, portfolios or blanket loans, as well as on the right-hand side, the fix and flip or bridge loans. The bridge loans will be interest only. They're short-term, usually only about 12 months. So the next slide, I think, goes a little deeper. It goes a little deeper here into the individual rental loan. We touched on a lot of this, so I don't want to go over it line by line. But the main thing to take away from the individual rental loan, it's 1 loan, 1 property. It's for a stabilized property. Stabilized meaning they have a lease. They have a tenant in place. Again, no limit to the number of properties owned. 30-year fixed rate, 650 FICO, 75 LTV. Again, we're going to calculate a debt service coverage ratio on that. Again, all non-owner occupied. And again, these are all non-TRID. So there's no LE, there's no CD, there's no LO comp, right? So you can actually charge points on the front, and you can actually possibly make yield spread premium on the back end, depending if the economics of the deal permit that. So something to keep in mind there in the single asset rental loan. The next one, again, we talked about this a little bit. This is the one that was in the middle. This is our portfolio loan or blanket loan. Again, this is going to be 1 to 4 family properties as well as smaller multifamily. We can do condos in with apartment buildings, single family all together. We typically require 5 units, minimum 500,000. Your typical client on this is going to own more than 10. We see that a lot, and they can actually do a purchase or refinance in the same transaction. So that's kind of interesting there. Again, we calculate a DSCR or a debt service coverage ratio. Loans again 5, 7, and 10-year fixed on a 360-month amortization. And the next product we talked about, this was on the right-hand side. Again, the bridge lending. A lot of folks use this for distressed properties. So this is buying something that needs fixed that you might flip, or what we're seeing a lot trend in the marketplace is using this loan to purchase the distressed property, fix it up, and then what we're going to do is move over and perm this loan out, or use a 30-year fixed rate once they get the tenant in place. So I have some more poll questions, but Eric, did you want to do any Q&A before we do the poll questions?
Yeah, certainly. There's a couple of good questions that came through. The first one is just in general about where they can do these loans through you guys. I don't know if you want to do that now or hold those till later. The other ones are a little bit more about where do you go to get these types of loans? And again, I don't know if you guys are going to cover that in the content later or not. Where do you want to go with that, Sam? Do you want to hold off on those questions for the time being, or you want to go ahead?
Let's tackle the first one first. Yeah, let's tackle the first one first, and then the second one we can do at the end. So
okay.
Where can they originate these loans? We showed a brief map up there of where where we're able to originate, and wherever we can originate, you can originate. So again, these are commercial mortgages on residential rentals, so they're not subject to NMLS licensing. 44 states throughout the U.S. You'll get a copy of this presentation at the end, and if not, feel free to shoot us a note after. But it gives you a national footprint by partnering with companies like us.
Okay, so not only does the company, the individual loan officer doesn't have to be licensed, but does the broker or broker company have to be licensed well to do these?
No, they do not. No.
Okay, that's cool. And so totally exempt. So if you've got an investor who wants to buy multiple properties in multiple states, or if you're a lender or originator who's worked with military families that, have moved 3 or 4 times over 3 or 4 years and have acquired a portfolio of loans, you do them all. Can you do blanket loans across multiple states?
Yeah, so we see that frequently. You might have an investor that has 10 properties, say, in Central Florida in the Orlando market. They might have 10 or 12 properties in Dallas. We can put those all together into one loan. So it doesn't have to be contiguous geographically. Not a problem there at all.
Awesome. All right. The second one was the second group of questions really kind of referred a little bit back to the stats, and one of them really kind of came down to a little bit more of the, what kind of projections do you see for the rental market growth? And I think they were looking more for a percentage year over year, how much gain in, percentage wise in the number of rental properties, of the demand for rental properties over the next 5 to 7 years.
I think I'll hand it over to Ryan. I think he has a little more analytics on that. Ryan?
Yeah, sure. I think that, as we look at the rental market continuing to grow and people coming into it, we think that it's probably going to continue to grow, as we have additional demand for housing, because we're really not building a lot of homes anymore. So a lot of what we're seeing is existing housing stock being renovated and then turned into rental housing. So when we look at the overall percentage of rental properties growing, we probably see that in the mid single digits on an annual basis, but we expect that to continue and maybe accelerate a little bit. One of the things that's actually pretty interesting about the rental market is it tends to be a bit counter-cyclical as well. When we saw the downturn, we saw the rental market explode. Obviously, 6+ million more renters. More than that in terms of rental properties. So as we do look forward and anticipate, somewhat of a slowdown, I think over the next year or two. We actually see that being a bit of a bump for the rental market, because we'll see more people migrate to rentals, maybe to weather the storm, and then emerge out maybe to look at buying homes afterwards. So again, long answer, but I think that we're probably, safe to say we're in kind of the mid to high single digits in terms of rental growth rate for the next few years.
Awesome. All right. One last question in this section. Kind of address the similar theme of the qualifying and what you have. people asking about how to get more information about your product capabilities, and like someone was asking for a matrix sheet, that kind of stuff. I know you guys have posted a bunch of resources in the resources folder. Audience members, if you open the resources tab, it's the widget that looks like a little paper with a pencil. It looks kind of like a Word document icon. So that is a great resource for grabbing some of that. Otherwise, how can our audience members get access to more detailed information about the breakdown of your products, like Sam was going over a few minutes ago?
So I'll take this one. I think that, as you see, there's resources that are available now. Our website has quite a bit of information, not only about our company, but also about our specific products and use cases, frequently asked questions, and all that kind of good stuff. If for some reason all of the resources, whether it's on our website or that we provided as part of this exercise, don't get you what you need, we have a hotline, we have a web Q&A. You can always email Sammy or myself, and we can get you additional information as you might need.
Awesome. All right. Well, Sam, if you want to carry on with the presentation as kind of planned, we've got a good flow of questions coming in. One last reminder to audience members, especially if you're watching this on demand, you have the same ability to participate. Go ahead and type those questions into the Q&A platform, even if you're watching this on demand. And the CoreVest team will be sure to get back to you with any of those questions that you want to get answered. That's what this whole platform is about, is engagement and your ability to get access to the information you want and need to do more loans. Sam, I'll keep monitoring the Q&A, and then we'll get to another Q&A section here in another 15 or so minutes, right?
Sure, that sounds great. So again, earlier in the presentation, we talked about some of these poll questions just to kind of stimulate your brain. Think about in the past, maybe some deals that you turned down, or you referred them to your buddy who might do these types of loans, and we want to educate you. We want you to know that you can do these types of loans. You don't have to give them away. So the question here, the next one is, have you ever turned down or referred away loans on portfolios of rental properties? And remember, that was kind of the product that was in the middle. Some in the residential space, this is kind of called blanket loans, right? That's the terminology that's used out there a lot when mentioning multiple loans, multiple properties on one loan. So if you could just take a minute and just kind of give me some feedback on there. I think we've already established earlier, you're seeing multiple clients that buy multiple rental properties. We noted that a lot of them don't qualify for Fannie or Freddie because of DTI restrictions. The one also said foreign nationals. We're seeing over 80% foreign nationals. That's great. So again, on this portfolio or blanket loan, just want to see your feedback on that. Great. So again, we're seeing over 60% have turned these loans away before. So it looks like there's 37% that haven't turned them away. So that's good. Hopefully you're doing business with CoreVest. But for those of you that are turning them away, hey, here's a great opportunity here to keep those loans in-house and create more revenue for yourself. So next question is going to talk about the structure of the loans, the entity, right? So individuals or joint, that's how you kind of usually close a GSE or Fannie Freddie investment loan full doc. A lot of investors want to close in LLCs or even LPs. We actually offer that also. We see a lot more LLCs, probably 90+% in our transactions. So have you ever had client requests to close loans in LLCs? Again, it's trying to make you think, trying to go back into that database, into that Rolodex of loan memory that you have. And have you ever had clients request to close loans in LLCs? Wow, there you go. That's great. So 100%. So we know the product's out there. We know the demand is out there from the investor space. LLCs is the entity they want to close the investment properties in. So one quick one before we get back to the presentation. Again, just last quick poll question. We briefly touched on this, but I just want to get your feedback. So how about prior to today, were you aware that you can offer some investment property loan programs in states that you weren't NMLS licensed? So did you know you could do loans outside of your license footprint by offering these business purpose loans or commercial mortgages on residential real estate. So hopefully we'll get some folks that say no, that they weren't aware. So that's great. If those are aware, that's great. I think you're going to be ahead of the curve. But a lot of you, I think there's some great opportunity to build your business outside of your normal footprint. Either if it's marketing online, if it's buying leads, if it's networking through investment clubs, investment real estate groups, a lot of opportunity out there to build business that way. So just want to see the feedback there. Great. So again, we're seeing north of 60% there. We're not aware that they could originate outside of their footprint. So love to see that feedback. I'm glad you're here today to learn about it. So that'll kind of move us on to the next topic, which is going to be, hey, how do we we talked about CoreVest, right? We talked about the investment property loans, right, and the clients out there. We've talked about the products that are out there for them. So how do you partner with a company like CoreVest to get paid for these loans? I think that's kind of the ultimate end play, right, is to create revenue streams. So let's look at the 4 kind of delivery channels or ways to send loans to us. A quick referral. This is basically filling out a short application. If the loan closes, you get paid an amount. It's not doesn't involve a lot of work from you on it. But we do want qualified candidates on it. So more than happy to discuss that offline. A Broker Plus, this is probably our most popular broker type of transaction. You're gonna compile the loan package. You're gonna send it to us, but we're gonna do most of the processing on it. So processing wise, we're gonna order the credit. We're gonna work with the AMC to order the appraisal. We're going to order the title. We're going to coordinate closing, docs, all that. The loan will close in our name. Compensation-wise, you will have the opportunity for kind of dual compensation where you can charge origination points, as well as you might have the opportunity to even earn a yield spread premium. So again, remember, there's no LO comp with these loans since they're commercial mortgages on residential real estate. So it does give you the opportunity for those of you that have been in the business as long as I have, pre-crisis days where you have the opportunity to earn income or to charge your clients on both sides of the deal to make it whatever works economically for them. So that's kind of how Broker Plus works. A wholesale, this is going to be similar to what you're probably familiar with on a normal wholesale transaction that you might be doing on a Fannie Mae or Freddie Mac type loan. You're going to order the credit, you're going to order the appraisal, you're going to do all the processing on the loan. So it does involve a commitment from you and your team. You'll submit it to us to underwrite. We're going to issue the conditional approval. You'll gather the conditions, send it back into us. We issue it clear to close. It's just that easy, and we go ahead and order the docs and close the loan for you. Again, the ability to earn yield spread is there. Also, the ability to charge origination points. More than happy offline to get you the details on that. On a correspondent basis, what we're talking about here is you're going to close the loan in your name. So in order to do this, these are for typically larger institutions that have a source of funds to close the loans. We do have private money lenders that use this as a takeout for their hard money loans, and they fund the loans with cash. But the way it would work is you're going to originate the loan, you're going to order the credit, appraisal, you're going to process it. You'll send it to us to underwrite for the most part. We're going to take on the credit decision or the risk on the loan. And then once we get the loan clear to close, we'll partner with you in drawing the docs to make sure you're comfortable and we're comfortable with that piece of it. But the docs will be drawn in your name, so you appear again as the lender. So a non-delegated correspondent relationship, I guess the best way to discuss how that works there. So again, four ways. More than happy to get you more information on that. So no, that's fine. And just the last one here, before we get into the other Q&A, we want to talk about next steps. So do this for me. The action items I want you to do is take a look back, just say 60 days. Are there any investment property loans that you had to turn down or maybe even refer out that might not have gotten closed? Take a look at those. That's a great way to see maybe they didn't qualify Fannie or Freddie because of the income documentation, but they had great rental income and they'd qualify for one of the programs that we talked about today. Begin with your immediate contacts that own portfolios of rental properties. You probably have these professional investors in your database. Reach out to them, ask them if they're ready to refinance any of their portfolios or perhaps purchase additional rental portfolios, and let them know that, hey, now you have access to capital. You have a way to help them fund those loans. And third, and most importantly, is to get us involved, right? Get your partners, your lender partners involved to look at the scenarios, to review the scenarios that you have, leverage our underwriting expertise, leverage our account executive expertise to help you build this business, to help build this repeat business, and to get you kind of the next level on investment property loans. So again, take a look back, contact your current clients, contact us for more help there. So one thing I did want to remind you also is to look in the widgets here in the webinar for more resources. There are some promotional items there for CoreVest, as well as broker application items. So again, in the widget area of, I always find myself funny saying widget area, but the widget area of the webinar, there's information to get approved with CoreVest, and also for some promotional materials there. So Eric, what I'd like to do is kind of move it back to you and see what other Q&A that Ryan and I can help our listeners. Glad to be back, right? Number 2, can't wait. Hopefully get invited back for number 3 to speak to the Originator Connect folks out there. But always a great time.
Absolutely. Yeah. Well, guys, I mean, wow, just a flurry of awesome questions here. And I'm just going to try and rip through them. These may bounce around a little bit on topic area, but I'm just going to try and rip through them one at a time as best we can. First one is, how long do the borrower need to be on title? Michelle, if maybe you can add a little clarity to that, exactly what you mean. I'm assuming they're talking about, because this came through when you were talking about the blanket loan, how long do they have to have been on title for that stable rental property before it could be rolled into the blanket loan? Any seasoning requirements?
Yeah, so the seasoning's really not going to affect when they could roll it in. What's going to affect is the actual loan amount and the LTC of the loan, so the loan to cost. So if it's different for every product. So we'll take it on the blanket loan side. We're really going to want them to own it more than a year to get north of that like 90% loan to cost ratio. So on the individual loan, once it's about 90 days seasoned, we will allow them to go a little higher than that. I think that answers the question. Ryan, is there anything you wanted to add to that as far as seasoning?
Yeah, maybe approaching it from a slightly different way too is we finance a lot of different scenarios. So if you want to purchase homes that that are rental properties, they're currently being rented, we do that. We do it also in refinancing situations. So we're pretty agnostic in terms of what the loan scenario is. One of the things that Sammy did mention, where he was alluding to, is we may have slightly different advance rates based on when you buy it, the rental asset. The only thing that we do require on our portfolio loans or blanket loans is that if it is a portfolio, we have at least 90% of the portfolio leased up at the time we make the loan. But that's really kind of the only restriction. But in terms of you owning the property for a certain amount of time, that's not very relevant in a lot of respects because, like I said, we do finance purchase transactions.
Awesome. So yeah, I mean, it's definitely a conversation of where and when we can bring these on. Some of these questions get into a little bit more of like property types. Like first one is asking about, can you do manufactured and rural homes?
Right. So I'll handle that one. Unfortunately, that's not part of our program now. We don't do manufactured homes. We do not finance what I would call rural homes. We like to be in primary and secondary markets, typically. We will look at tertiary markets, and what I mean by that is, a market that maybe slightly outside of a major MSA, but it has good growth drivers. Maybe it's a commuter city into a bigger MSA. We'll certainly look at those. But if it's farmland or big estates, big properties, call it over a couple acres, that tends to be outside of our lending box at this point.
So if you had an investor, for example, who wanted to buy 30 acres that's in a growth area to be able to put 50 homes on that 30 acres, you'd do that, but not necessarily the the 30-acre plot that has one house on it type thing.
Yeah, that's correct. And that's actually been an interesting part of our business here over the last 6 to 9 months. And that is build to rent, particularly in the Southeast, markets like Charlotte, like Atlanta, where groups have either purchased finished lots or have actually purchased land and are doing the clear cutting, and they're actually building rental communities rather than owner-occupied communities. It's actually quite an interesting business model. We're seeing lots and lots of people do that. And in the markets that they're in, again, particularly the Southeast, there's a tremendous amount of demand, and a lot of times people are building these properties expressly for rental, and as they're kind of rolling out the production line, we have many people that already want to rent those homes, so that the lease-up happens pretty quickly. And as a lender, we can finance the vertical construction and those types of projects, and then also provide the takeout financing and a long-term loan. So it's really soup to nuts financing for those development partners.
Awesome. Well, we got a ton of questions. Well, folks, keep posting those questions in, even if we don't have time to get through all of them before we run out of time here on today's webcast. The CoreVest team has promised they will get answers back to you on these questions. So I'm going to try and filter through here and pick out some of the better questions. But I did want to mention something that's kind of an interesting trend that we've seen in the Midwest, especially is with these urban living communities. If you've seen that kind of a trend, they're essentially planting an urban environment in the middle of a cornfield 10 miles out of town, or right next to, like, we've got a bunch of really popular ones in Kansas City area, right? For example, right next to the main campus for Sprint Telecom down in the southern part of the area, on the Kansas side, more so than Missouri. But there's some really cool communities that have restaurants and shops and entertainment and venues and bars, and then above that, everything from third floor up is residential. Are those projects that you guys do as well? The development and you said vertical construction and long-term hold?
We are looking at projects like that. We've looked at several of those business models here recently. We're really starting to see that come out of the woodwork. We're focused on residential investment properties, and so that can be a single-family home, condos, townhomes, and then multifamily, and then we're seeing all kinds of derivations of that with these residential living communities. We're starting to see more and more of those pop up, and we want to be a leader in that space as well.
Absolutely. All right. So there were a number of questions, and I won't cover all of them one by one, but there were some questions about working with you guys from audience members like Lewis was asking about. He's an LO who works for a lender. Does the lender have to be approved with you guys, or can he just refer or broker to you directly kind of outside of his lender?
Well, so it's a couple different things there. So I wouldn't want him to do anything outside of his employment agreement of his current employer. So I would definitely check with your employer on their policy. The company itself, for our individual single asset rental loans, the company does have to get approved. There are a broker agreement that has to be signed. If he had an independent company or maybe had his own LLC, we're more than happy to work with him. But again, I would always refer people back to their employer. You never want to jeopardize, right.
Right. The next question that's in here is what is the difference between the broker and wholesale partner program? Can you clarify a little bit the differences between those two different programs?
Yeah. So the Broker Plus, that was the second delivery partner program we talked about. That's the one where we're going to do most of the processing on it. So if you don't have a big infrastructure, perhaps. Or you have a large infrastructure and you're concentrated more on those Fannie, Freddie, Ginnie Mae loans, and this is kind of a new thing to you. Start with Broker Plus. Let us do the processing, order the credit and the appraisal, and chase down the conditions for you, and then you can kind of graduate to the wholesale side. We do want our wholesale partners to deliver a larger amount of volume, because we are giving them a little better pricing, and they have an opportunity to earn a little more income on those loans. More than happy to discuss that offline. So I think that kind of differentiates the two. So Broker Plus, we're going to do a lot more of the processing of the file. On the wholesale, the partner is going to do most of the processing.
All right. Okay. So it really it's how much work gets done by who, right, is the differentiation. I'm assuming there's, equitable compensation shift between the two models. The more work you do, the
Correct.
more you get paid kind of thing, right?
Correct. Yep. Absolutely.
Okay. There's a bunch of questions that go in here into, kind of the variety of product and asking for matrices and stuff like that. We've kind of addressed that already, but, guys, resource tabs or website in the widgets here in the platform are good as well. There's one question in here that really got into what are the best ways to meet folks who need these types of loans. And I'll just throw in my 2 cents as a business coach for many, many years here. One of the best sources I've found for these types of loans to work with real estate investors is either one, going directly to the real estate investor groups like REI and those kind of associations that are local network groups that have kind of their own, for lack of a better word, kind of a handshake MLS, because they all network together, right? They do deals together. They have properties they want to get rid of. They have properties they want to acquire. They need partners who have more capital than they do, and they network together as a group to help each other grow. Those can be great places to go. Other great places to go for that type of stuff is CPAs. Every good real estate investor is going to have a great CPA in their back pocket, and those CPAs know who those investors are and can refer you more business as an originator, which stimulates more billable hours for that CPA. So it's kind of a win-win-win situation. If we can work with the CPA, do a cross-collateralization loan on their current portfolio, free up some additional capital to accelerate that portfolio growth, like I said, it can be a triple win. Any other thoughts, suggestions? What do you guys see among the loan officers who you work with as far as best strategies, best practices when it comes to going out and getting more of these loans?
Ryan, do you want to go first on that one?
Yeah, sure. Look, I think, Eric, you bring up some good ideas, and I'll tack on to that. I think the folks you're talking about are kind of those in the ecosystem. One group in particular, or I guess a classic group, it would be property managers. Those are guys that are obviously working for investors typically. And so they tend to have investors, trading in and out, and then also working over a long period of time, but they tend to know who the buyers are, either that they're working with or they want to work with. So calling on property managers tends to be a pretty productive exercise. And also just getting some dashboard time. I mean, I think depending on the market you're in, you might see, rentals out there that might be, owner managed, or you might see fix and flip projects in motion. A lot of times you can, tap into folks that may be doing it on their own or with friends and family money. And if you talk to them about financing options, you can often find folks that way as well.
Awesome. Some great comments there. All right, guys. Well, we only have about 3 minutes left of the scheduled program. If you guys are able to stay on for a few extra minutes, we can maybe hammer out a few more of these questions. But I know you guys had a special offer for our audience, so I want to make sure you have time to get that out before we hit the top of the hour. Sam, you want to jump in and share what you're talking about with these guys?
So what we'd like to do to offer to the Originator Connect attendees here today is on that single family rental loan, that single asset rental loan. We're willing to give you a special rebate of an extra 25 basis points. All loans submitted here in November. So you'll see a certificate I think is available in that resources center. We're also going to email it out to you. So again, these are for 1 to 4 family single asset rental loans. You're eligible to do those in 44 states, 650 FICO, 75% loan to value, 30-year fixed. Keep that in mind when you're talking to your investor clients. Gives you an opportunity to earn a little more money for the holidays, a little more money for a big New Year's party there, or whatever you might be. Great way to kick off 2019 and finish up 2018.
Absolutely. And guys, like you said, Sam was saying, go ahead and go to the resource list tab. It's that widget that looks like a Word document icon, the sheet of paper with the corner folded and the pencil across it. Go ahead and open that sucker up, download that broker application and the certificate for this special offer that Sam just told you all about. Guys, if you want to chat to me, let me know how much time you really have to hang on here. There are a flurry of additional questions in here that I'm even a little bit of a loss as far as which ones to cover next.
Well, I did see one. Someone asked about commercial financing, multiple commercial, which I did reply back. What I do want to note on commercial is we're not doing commercial office space or retail space. We will look at some very, very small, limited mixed use. Typically want it to be about 10%, of the rent or 10% of the portfolio, and we'll discount some of that. But traditionally what we're looking for, if someone's living there, that's the type of loans that we do. I try to tell people. So apartment buildings are great. You can mix those in with single families. All those are available. We can go up to 200 units and even an exception above sometimes 200 units. So keep that in mind if you get apartment buildings in your space there. I can take a look at some of the other questions. Saw a couple more just popped up here. Someone asked about escrowing for taxes.
Ryan, if you want to read through as well, if there's any ones that are like hot button questions that we haven't covered yet in content, maybe let's focus on those.
Yeah.
Sure.
Requiring escrows for taxes and insurance. Yes, we do require escrows for taxes and insurance. Thank you there, Brooks. Let's see. We talked about the difference between the broker and wholesale. That's great. Let me move down a little bit. Loan matrix. Sure. We'll get that out to you, Jack. Thanks for asking. There. I don't know what Keith said. Who can I contact? Sure. Several scenarios. My number's right there. There, Brenda. Feel free to reach out. Glenroy there. He's in the 248 up in D-Town in Michigan. He's asking for a link to watch this again a later time. Eric, I'll let you answer that one.
Yeah, absolutely. Within about an hour of closing this webcast, you'll automatically be able to watch it on demand using the exact same link that you registered with today. Now, keep in mind, you're also very welcome to share information about the direct link. Like I said, if you've got investors or realtors that you work with, if you've got builders and developers you work with that you want to watch this program with you to get some of the insight directly from these guys of how we can help you grow your market, feel free to share that. If you hit the refer a colleague, it's the button that looks like a guy in the center with the bubble of other people around him. Go ahead and hit that button. You can email it out to anybody and everybody you want. You can share it on social media through the widgets as well. If that's your preferred method of communication, feel free to share this because the video of this, and by the way, their ability to ask questions is also still going to be the same. The on-demand viewing experience here is just the same as those of you that are watching this live. So that's a great, tool of this platform. All right. Yep. We are just a little bit over time, guys. I guess we'll give you kind of one or two more shots at, are there any other real super hot button questions that you want to make sure you address live before we close this out?
Yeah, it looks like Tim asked, is a new broker able to utilize, our B2B program? Absolutely. Tim, we work with, we see that a lot. It's a great time to be a broker. There were many years it wasn't a great time to be a broker. So if you're going out on your own and hanging your shingle, hey, congratulations, and we're willing to partner with you on that.
All right, also awesome. The only other one I saw that might be of some interest, takes us back into a little more technical, you guys decide whether you want to take the time to answer it or not, is what's the difference between loan to value and loan to cost? If you could explain a little bit more what loan to cost ratio includes.
Go ahead, Ryan. You want to hit that, Ryan?
Yeah, sure. Loan to value is pretty straightforward. Value is described as the current market value of the property as determined typically by an appraisal. Loan to cost is the loan to the cost of the borrower to acquire that property and any additional capital that was put into it for improvements. So if you bought a property for $100,000 and you put $20,000 into that to improve it, simple math, $120,000 cost basis on that. So that's how we look at loan to cost, LTC.
Awesome, awesome. Well, guys, just a wealth of information today. Hopefully all of our audience members, our Originator Connect members across the country have gotten some significant value out of today's event. Again, like I said, like, share it, follow it. Always be watching your emails for upcoming notices of additional webcasts to come in the future. And watch for a new show coming up starting in January called The Fix that will be focusing almost exclusively on this area of lending opportunities for you guys. Make sure you plug in. If there's anything, by the way, that you would like to see more information or have us go out and attract, folks who can talk intelligently and educate you on a specific area of lending, as an Originator Connect member, we want to hear from you guys as to what you would like to learn more about, and we'll go out and find the resources for you on that. Feel free to take advantage of the opportunity to make those comments in the survey that'll pop up as soon as we close out here, guys. Again, thanks for attending. Ryan, Sam, thanks for doing such an amazing job with sharing some incredibly valuable information today. Last call, guys, for any additional questions, any comments that you would like to get addressed in the platform here. Otherwise, you can always reach out to these guys at the contact information that you see on your screen. Thanks again for joining us, and make it a great week, everybody.
Thank you.
Thank you, everybody.